Welcome to Stocks in Translation. I'm Jared Blickery, your host, along with the voice of the people, Sydney Freed, right here. And a quick request first, be sure to like, subscribe, and comment on Stocks in Translation, wherever you get your podcasts. And today we are welcoming Jessica Inskip. She is She is the Director of Investor Research at stockbrokers.com. And today we're going to be talking about the 2025 investing landscape. Our phrase of the day is financial literacy. The trend is going the wrong way for the youngest generation, says our guest, why influencers are part of the problem. And this episode is brought to you by the number $400 billion. That is the projected spend on AI infrastructure this year, how the AI trade is setting up for 2025. So Jess, let's begin with your 30,000-foot view of what's going on in the markets right now.
So I think we have a really big catalyst that we're going to end the year on, which is the Fed the Fed cut cycle. We want to be in an easing cycle. And then going into next year, I think it's still some of the narratives that we've been seeing. It's AI, but that's going to expand. That's going to expand to grid pressure and more on energy. And that has to go in line with a Fed easing cycle. We couple that with deregulation. That's going to be a much better environment from a CapEx perspective for those hyperscalers to spend and expand, and we definitely need to see that. And then couple that with some headwinds that we could potentially have, which are those tariffs. I did a wonderful study going into the deep dive of Trump 1.0 to see what was happening with tariffs. The thought of tariffs definitely didn't spark volatility because it was used as a bartering tool. We weren't unsure what actually was going to be there. But once they were implemented, we actually did see volatility of about 18.5%. But that was coupled with a restrictive Fed. So that brings me back to
which is what we do not have right now.
Exactly.
We got a Fed that's easy. I want to get to our phrase of the day, financial literacy, and let's just define it first. Financial literacy is the ability to understand and effectively use financial skills like budgeting, investing, savings, and management of debt to make informed decisions and achieve financial goals. As an influencer here, you've got some opinions about, your cohorts and how they approach financial literacy. Just give us an example.
The way that I perceive financial literacy, first of all, there's always this talk of not being able to time the markets, but you can prepare for the markets. Meaning I can understand that the Fed is going to lower rates and when, because I understand how the Fed works, understand the impact on the yield curve and how that subsequently affects the consumer and then your investments. So that to me is the crux of financial literacy, is being prepared and being understand.
Having a plan.
Having a plan, but also understanding those steps to make that plan.
But this is tough because, I guess I'm only speaking for myself. They don't really teach you a lot of this in school.
I don't think you're speaking for yourself.
I'm trying not to make a broad generalization.
For the people. Yes.
I am the voice of the people speaking for the people. I think I took like a basic U.S. economy class in high school, and that was it. I don't even know if I learned a single thing about the stock market.
So that starts with the root of the problem. Now we go to the way that Gen Z likes to consume information. It's not Google. Back in my day, we Wikipedia'd or Googled, but it's
seems quaint.
Yes, right. It does. Nonetheless, it's via short form content and it's via TikTok. And if you think about the type of people who are producing content on TikTok, not all are bad, but the vast majority, due to the regulation that is around finance in general, have no experience and they're self-taught. Therefore, they don't know when interest rates
they end up
are going to
pumping
come
the wrong
down.
crypto.
Well, that, and even those that have good intentions, I feel like a lack of information could still lead to misinformation. For example, there is now going around social media say, why are my high yield savings accounts suddenly dropping? Well, we knew that for sure in September when the Fed dropped rates. However, TikTok wasn't stating that because they haven't experienced that before, or they haven't worked in finance and taken the time to understand what these concepts
Interesting. It seems like there's a huge opportunity because you could get ahead of a lot of these things that we see coming. So what's the first step in executing a plan? I guess you need one, but how can an investor just sitting here who's not really doing much or planning much, how can they take that first step?
So I do believe it's financial literacy. The analogy that I love to use is a home. While we're investing is we're creating our dream home, aren't we? And the foundation of that dream home is financial literacy, understanding it. That's a solid foundation. If you go to the first floor, that's your retirement floor. That's where you start. A lot of times I talk to people who are older and that generation that experienced the great financial crisis. Well, they they feel like they may be behind, but if you have a W-2 paycheck, you probably were contributing to Social Security. That's a big component of it. A lot of people don't know to go to SSA.gov to look and see what you already have. And that generation most likely bought a house with really, really low interest rates at a really low price with a lot of equity, which is still an investment nonetheless. So that's why I say financial literacy, is because one, understanding that where you are in your process, and then we layer on the self-directed investing approach. We are now at $0 trades since 2015.
And self-direct means you're trading for yourself.
Correct.
Okay.
Yes, absolutely. And there's automation and hybrid versions of that. But now that every brokerage firm has essentially no cost, the way that they attract clients is via the features and tools that they have. And there are some that are incredible that bring in even institutional level research, tools to help you find ideas, tools to help you set goals, tools to help you understand your retirement number. So it's understanding where you are, what you need, what level that of hands-onness you would like to have, and then the tools and resources that you need to get to that path. And then, of course, that constant understanding that it is when you're building your house. You're the architect, if you will.
I like that.
I guess it does depend on your timeline, though, right? Like, how much do you need to know in this moment? If you have a long runway and you're only really interested in like ETFs, is it enough just to kind of like know how to pick an ETF? Do you need to know how to do other things? Like, I guess I'm just wondering the state of education at each level that you need.
Yeah, so I think that's up to you, what level of detail and what level of hands-onness that you need. But what is important is starting early. I talked to someone who said that Gen Z hates the word retirement account. And I found that interesting.
I don't like that either.
Because they feel, and if you understand this, I suppose the psychological aspect of it, I'm in my early 20s. I'm not going to retire yet. So I like to call it future you. I'm going to care for future you now, just rebranding it.
Okay, but that's just that's no substantive
voice
difference.
That's true. It's a psychological aspect of, I don't need to care for my retirement. I'm young. But in all reality, if you pull up a compound interest calculator and you remove 10 years, it's usually a $1 million difference.
Yeah, it's always the last 10 years where you get those huge exponential numbers. I want to get back to influencers for a second.
Sure.
How would you go about vetting influencers? If you're somebody on the street who you don't necessarily understand what you should know, but you also don't know how to judge the people who are supposed to be giving you that advice. So what do you do?
The way that I vet them personally, I will go through and look at their TikTok or whatever social media we're trying to analyze and say, can you explain what a stock is? Just basics.
I've seen you do this.
Yes.
I know it can be done.
It can't be done. But it's the basics. Do you understand the basics? That's where I would start from vetting. Secondly, what is their background? We can Google search or chat GPT that person's background. Have they worked in finance? If they haven't, that's okay. How do they position themselves? Do they call themselves an expert and they're not? Or are they saying, learn with me? I think there is a difference with the type of
Which is
person
valid too.
Yeah, absolutely.
I think as long as you disclose that.
I completely agree. What I do have a problem with is those who call themselves finance experts or money experts and have a marketing degree. And they found themselves at the right place at the right time when COVID happened, investing became a trend. And we had this broader retail participation that the market didn't anticipate. We've all been anticipating the great wealth transfer, but this isn't the way that we thought it would be via GameStop, which is fine. We adjust. We don't know what's going to happen with markets. Nonetheless, those people suddenly have these huge followings without the expertise. Now, when markets shift, like getting into a restricted
And there's a
Fed
temptation
cycle,
there. Like, I have all these followers. I'll just monetize that one time, not necessarily thinking of the fallout, which is that these people could be getting really bad investment advice. You mentioned regulations. I want to hit that now. What's wrong with the regulations on social media, and why is that kind of perpetuating this problem?
So they're antiquated regulations. If you were looking on TikTok and just take a moment, have you ever heard somebody say, hey, I'm Jessica and I work from Fidelity Investments, or I work for Merrill E-Trade? You have not. And there is a reason behind that. It's not the brokerage firm's fault. It's just the antiquated rules that were made when AOL came out, if you will. So it's FINRA Rule 2210. That's the communication with clients. It says any communication with a client that goes to 10 or more people via electronic means has to be reviewed by someone in compliance. And then you follow the compliance procedures, go down that rabbit hole of rules. It has to be an auditable process, so continuously reviewed. And that's inclusive of prospects, which is going to then put you on social media and any commenting, since it's technically allowed as long as someone reviews it. But if you look at people who work at self-directed firms, everyone who has a Series 7, that introductory license, that's thousands, hundreds of thousands, and you may have 5 compliance people. Therefore, it's too costly. And it's not going to happen.
It's not workable. So in other words, the system is stacked to not allow social media to, I guess, effectively work for investors.
That's right.
In any way, shape, or form. Are there efforts underway to maybe change the legislation on this?
So that's where I've been working on. I actually found myself at a conference talking to the Commodities Futures Trade Commissioner, and I introduced her to these rules because her keynote was brokerage firms. Why aren't you doing this? Why aren't you here? And the way she explained it to me, it's a federal versus state level type of SEC versus FINRA.
That's always big with the regulators.
Isn't it?
Oh, it's the state guys.
I went all the way up to the person who reported directly to President Biden is where I found myself.
Wow.
And then she got me in touch with Sarah over at FINRA, and I explained to her. And then this also opened up a bigger issue that I realized. There are some people who are wonderful that are learning financial literacy and the younger generation, and then decided they want to have a career in finance. There's one person, her name was Kristen. She was the Stonk Queen is what she was called.
Stonk Queen, all right.
But she had great information, over 250,000 followers, had to remove every single video because she decided to pursue a career in finance in the self-directed space. So not only are we not making a place where it's regulatory friendly for...
You're taking down great content.
You are. You're discouraging those who want to take the correct steps to learn in the right place from being content creators.
All right, we're going to pause right there. We need to take a short break, but coming up, we're going to be digging into AI infrastructure and the hundreds of billions being allocated to big data. And weekends aren't just for Bitcoin as trading goes round the clock and heats up here. We are back, and this episode is brought to you by the number 400 billion. That is a dollar amount of the total spend on data center capex, and that's just this year. And that's $400 billion. That is up 35% from the last year. And Jessica, we were talking about early on some of the trades, call them the Trump trades, things we can expect for the next year. Infrastructure is one of them, but this AI spending, that's a huge one. Talk to us about that.
Yeah, so I love how we constantly talk about how the S&P 500 perhaps is overvalued. And when we do that, we look normally at the forward-looking price to earnings ratio.
Sure.
If you disagree with that statement, you believe something in that P divided by E is incorrect in the equation. And in my view, it's the earnings anticipation.
The bottom, the
right.
denominator.
Exactly. So nonetheless, when we are going through these earnings of the hyperscalers, one constant theme is we're still spending money. We're spending more than we thought on AI. Where is that going to be? Well, it's the data and grid infrastructure. We're built, and that's one component of it, but a bigger theme that I think we're going to see emerge in 2025, because we have such antiquated infrastructure globally and even domestically, and a lot of it is government owned as well, which means there's opportunity for private investment, and that's an early on theme that I'm seeing within my research. So nonetheless, I really think that's a big theme that we're going to see. We've already seen it with uranium and that nuclear view that's coming out, rebuilding, but it goes beyond that. One ChatGPT prompt, do you know how much electricity it takes?
I want to know because I type a lot of them.
The same question with water, but yes.
Yeah, so it's like leaving a light bulb on for 15 minutes.
Wow.
I can see that. There's a lot of thinking going on right now.
It's 10x. It's 10x. So it's growing exponentially. So therefore, there needs to be a solution very, very quickly.
And in terms of investors investing in the public markets for all of this, how are you viewing that right now? How are you viewing AI investing?
So what I think the early opportunity would be is something like BlackRock. BlackRock is taking that private equity strategic lens. They have a partnership with someone who goes into the waste management and everything with that, not just data management, but infrastructure in general. And so that exposure to their portfolio is something that's going to help their earnings and translate over to earnings. So I think that's a good investment from the self-directed perspective, where you can get that type of exposure without knowing directly what company is going to expand that infrastructure. And then, of course, the broad-based uranium ETFs and things like that for nuclear.
Let's stick with the 2025 investment outlook here. You mentioned tariffs before, the deregulation agenda. What do you think happens with respect to those, and where does it all kind of shake out in terms of sector action or styles?
So I think we have to take a step back, like I said earlier, looking at what happened with Trump 1.0. Tariffs were utilized as a bartering tool. Definitely so many studies. It is inflationary, absolutely, and it's passed on to the consumer. And if the consumer is willing to spend, we don't know that. That's not something we can put in any type of equation or models, is consumer behavior. So that's certainly an unknown. However, if we look at what happened in the past, there's volatility once it's implemented. This is the most important theme that I will be watching in 2025, is ensuring that we stay on that Fed easing cycle. Any sudden hot inflation, and I know at the end of December, there was a slight scare of heating inflation, but that's what I would be concerned with. If we couple tariffs with a restrictive Fed, then we're going to face a really big headwind in 2025.
When you say volatility, do you just mean in the markets, or do you mean in the economy? How do you kind of view that?
So all interconnected. Volatility and uncertainty go hand in hand with me. And there's one thing that the market doesn't like, is being uncertain. And then we get volatility. You're on a more gyrating roller coaster, if you will, lots more ups and downs. But that goes back to financial literacy. If you understand why there's volatility, we understand that there's tariffs, or you can prepare and say, oh, the CPI was hot, PPI was hot, PCE was hot. Perhaps the Fed's going to be less restrictive. We look at the dot plot, or be more restrictive, excuse me. Then you know why. That's what I mean with being prepared.
Yeah. I like, because you can get your mindset that you might have to make a decision in the next few weeks. I might have to pull that trigger. It's not just coming up on me on a Sunday night and I'm kind of blindsided here.
Exactly.
Talk to us about the Fed, because how do you prepare for the Fed's next action? 2025, do they keep lowering rates, or if they're not, what are you watching for as a clue to what they're going to do next?
So we have to watch what the Fed looks at. It's the Fed making the decisions, not us. I'm a big Taylor Swift fan.
Oh, we know this.
Yes.
Swiftie.
Yes, even have bracelets on today. Nonetheless, I do believe, just like if Taylor Swift fans, we look at everything that woman says to understand when she's going to re-release her CDs. Those are context clues.
And the location of the Easter eggs.
And yes, thank you, Jared. The same applies here.
Yeah, I know.
You do know.
Thank you.
That literal concept applies. We know that the Fed's dual mandate is maximum employment and price stability. He's given us indication and is, in fact, more transparent than Taylor Swift, because he speaks more than any Fed chairman that we've ever had. So it's paying attention to what he says and listening for clues. He's data dependent. He's going to look at it meeting to meeting. So if we see a sudden spike in unemployment, we do have tools to assess that. But if unemployment is suddenly very, very low, then that might even feed into fiscal policy that we have to understand. Is immigration, what's going to happen there? What's happening with Trump 2.0? And there's actually some really fun data on that as well.
Watch those weekly jobless claims reports. They sound boring, but they're actually quite incisive. I want to get to who wore it better today, because they say Bitcoin never sleeps, but weekends are not just for crypto anymore. 24-hour trading is here for stocks, depending on your broker. Some alternative trading systems now let investors trade overnight, even over the weekend. And Jessica, you say options trading might be on the horizon. So let's use our imaginations here and determine which asset class is wearing the prospect of night and weekend trading better. So we got options, we got crypto, we got stocks, maybe gold.
Oh, I'm going to always say options because, that's my specialty. Yes. I would say they'd wear it better because options, when used correctly, are a risk mitigator. They can de-risk your portfolio.
When used correctly.
Sounds
like a big one.
Yes. And so if I can do that overnight, that's very, very helpful. Whereas you might have an expiration on a Friday and can't get in on the Monday, we lose the weekend.
But options are so complicated.
They
are.
I
always say it, but it's the one thing where no matter how many times someone explains it, when I have to think back on it, I'm like, do I get it? Are options for your everyday investor?
They're not, because of that complexity. Not everyone needs to understand and beta weight their portfolio.
Well, this is the answer of an honest influencer, by the way.
Yeah, well, it's because they're complex. And I think naturally as humans, any things that are complex, we tend to fear them and put them in this corner of perhaps they're bad. They're not, but if used improperly, they absolutely are.
Okay, but picture this.
Okay.
Me, Sydney, I want to get into my first option.
Pulling out the calculator.
Pulling it out.
Doing the calculations by hand here. I can see it.
I want to pick a play. How do I go about my first options play?
So I think the first options trade, which is not the first options trade everyone's going to do, the best one is a cash secured put. Because
get you in
cash secure what?
a cash secured put.
Secured put.
to get you into a stock.
I'm writing this
Yes,
down.
exactly. Because you take the same risk as buying the stock.
I listened the last time we did a segment.
I
All
love
right.
this.
Well, I'm always still learning. Okay, so wait, explain more about this.
So when you are buying a stock, the most that you're risking is the amount that you spent, right?
Right.
When you sell a cash secured put, you are securing the cash that it costs to buy that security. So the equivalent risk. One contract always represents 100 shares. So 100 shares of Google, if you want to get into it, NVIDIA, whatever security, even SPY, if you want to do the ETFs.
Kind of passive.
Yeah, absolutely. We could still be passive with this. You receive a premium for doing that.
You
And
get money up front.
exactly. And what that does is you create almost like a bracket. So for simplicity, say your strike price was $100, you received a premium of $5. If that moves adversely, moves down ABC stock to your below $100, if you bought it at 100, you would lose $5. If it was at 95, if you sold the cash secured put, you'd break even because you received $5 and your obligation kicks in. You would own it at 95, not 100. So essentially you buy it at a discount. Options have a give and take though. That's the give.
Yeah.
The take is you got to think about that.
Well, that as well, but there's upside risk. When you own the stock at 100, you're getting a $5 premium. That becomes your maximum gain potential on the option side, whereas the stock investor could have much more higher capital appreciation during the duration of the contract. So you don't want to do that on something that you're very bullish on. You want to deploy that strategy on something you are neutral to bullish on, neutral short-term, bullish long-term.
Great explanation for first-time options traders.
Where there's a
there.
strategy for everything here.
There is.
We got a minute.
Yeah, we just want to get a little personal. So you are on TikTok. Tell us a little
We've heard
bit.
about
Yeah,
this.
we've heard.
Yes.
Tell us a little bit about your own content and deciding what you put out there, what you make that day.
Yeah, it was honestly started as a little experiment. I was kind of afraid of it because this is easier than TikTok. Nonetheless,
I'm going to take your word for that.
I talk about what's happening within the stock market, but I relate it in some very ridiculous ways, and that tends to be relatable, but I still talk about that crux of financial literacy. I'll explain what the secondary market is, what's happening with the Fed, and why you should be prepared. And that really resonates. And to get on the personal level, I did have to give up my financial licenses personally in order to be on TikTok. And it's not a sentence that should exist, and hopefully that will change one day.
Yeah, you're fighting to change it.
I am. And nonetheless, there's still some great content creators out there. I'm not bashing all of them at all. However, I do think we should just open the floodgates and
Open the floodgates,
floodgates.
And a little bit of regulatory review here, please, from the likes of FINRA and the SEC. Well, guess what? We are winding things down here at Stocks in Translation. Make sure to check out all our other episodes on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to leave a comment, and subscribe wherever you get your podcast. We will see you next time on Stocks in Translation.